Chair Jerome Powell issued a stark warning that the Fed's plan to fight inflation is likely to cause, quote, some pain.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
The banks have gone down from lending 75% to 50%. So there's less leverage in the markets. The buyers are saying, well, Powell is not done raising interest rates, so I can't buy it at today's valuation. I have to buy it at next year's valuation because next year it'll be worth less, right? Because if you're buying a cash flow property, you want to get it to cash flow above the interest rates that you're paying, above inflation. So you want to make money in real terms. Mm-hmm. So everything is compressed down, and there's uncertainty because maybe interest rates, are done next month, but maybe in 1 year, maybe in 2 years, there's uncertainty about the policy. And that's what he means by pain, because this uncertainty is freezing everyone. And then for the households, what he means is, look, growth is stagnating, so your wages are going to stagnate. It means that real estate developers are not going to build as fast, so it means less available housing, rents will go up, etc. All of this thing is a huge reset of the valuations in this world as per higher interest rates, in order to make sure that what we have is, fairly high inflation, but not runaway, embarrassingly high inflation.
Welcome to the RTD interview. Today, I'm excited to have returning guest, Mr. Lior Gantz, the founder and creator of the Wealth Research Group. And today, Lior is joining us to share his thoughts on the global economy, as well as some practical, everyday steps that you can do to take advantage of opportunities in the future. So, Lior, how you doing, my friend?
I'm doing well. Thanks for having me back.
Yes, I appreciate you for taking time to join us. It's been a while. So I think we first connected earlier this year. And of course, a lot of things have changed since then, but it's always great to plug in and see what you're keeping an eye on, as well as look for opportunities amongst all this chaos. But before we dive further, I'm curious to get your thoughts on where we're at now as we're entering into the end of this year. What are some things you're keeping an eye on that could be more problematic? And then we'll get into some of the reactions and solutions along the way.
I think that in general, we're in a part of the cycle where the Fed is raising interest rates, and throughout the world in tandem, all central banks are raising interest rates. And that primarily raises two questions and two concerns that we have not yet answered properly. And the market is just resetting every asset class towards answering those two questions. And the question number one is basically, do we have a hard or a soft landing because of interest rate hikes? Or, in general terms, how much should we price real estate, stocks, and everything else in a world of X interest rates? So everyone is just trying to forward look how many interest rate hikes the Fed will still do. So if you are in the camp that says interest rates are going to 5%, in your world, assets should be worth X amount. If you think it's going to 4%, then asset class should be worth more. If you think it's going to 8%, then et cetera, et cetera. So what the market is grappling with is this reset of valuations, because we're getting out of ZIRP or zero interest rate policies. Because I think understanding zero interest rate policies and the fact that they've ended, that's it. They've ended and not coming back for the foreseeable future is critical, because what the markets were thinking about right now, and this is the second question, is what happens after the Fed stabilizes interest rates, after they get to a point where they say, okay, you know what? If we keep raising them, all we're doing is risking a tougher time, but we're not going to change anything regarding inflation. Once they get to that point, what do they do next? And the markets were pricing in rate cuts. It's almost like they thought, they stretch that thing and then they release it. Whereas what Jackson Hole and the speech that Jay Powell gave there, it kind of sunk for the first time in the eyes of the market that no, what they're probably going to do, and we can talk about Jackson Hole and exactly what he said. But what they're probably going to do is they're going to raise interest rate until that level where they feel very comfortable that it's working, it's working beneficially, not working destructively. And then they'll probably keep interest rates there for a while.
You mentioned, the Jackson Hole speech, and one of the things that every commentator talked about was the emphasis on some type of pain. And so ultimately investors experiencing some type of pain, but it's going to be necessary in order to, I guess, help stabilize or land this thing or whatever they're referring to. So this pain he's referring to, in your opinion, what exactly will this pain be, and how will it play out in the days ahead?
So I don't know when this airs, but today's the 6th, and I just got a call from a real estate fund, and they were pitching me on a deal. So I want to explain to you what pain means through this pitch. Okay, so in this particular scenario, and then I'm going to take that little scenario and I'm going to broaden it for the whole universe of stocks and what fund managers are looking at in banks, the economy, etc. So in a nutshell, this is a company that bought a multi-family building in Manhattan in 2016 with the purpose of refurbishing it. So the real estate funds do is they try to raise rents by renovating each unit and then getting the entire building into a better level of cash flow, and then they flip it to an institution that wants to buy and hold for the cash flow. Good. So they've done all of that, and now they want to sell it, and they bought it in 2016. If they want to sell it now with better rents, completely remodeled and everything like that, the price that they will sell it at is less than the 18. Okay, so you're saying to yourself, well, okay, let's say it's 17. So what? So in 6 years they lost like 5% of their investors. That's nothing. Well, remember that these funds are leveraged. So the investors put in like 3 or 4 million, and the rest of it is financing. So if they're selling for 1 million less, and they put 4 million in, that means they lost 25% in 6 years. That's it. That's your deal. Whatever you put in 6 years, you lost 25%. That's horrible. So what they're doing is they're trying to change these distressed investors into new ones, and they're giving the new ones better terms. So they called me and asked me, do I want to go in at a 2-to-1 valuation? So let's say there was 4 million involved at first. Well, for your purposes, assume there was only $2 million at first. So even if I sell this property at 17 million instead of 18 and we lose $1 million, you will gain 50% because your valuation is at 2 million and I just sold it at 3 million. Okay, so and I'm asking him like what's going on? So he says, look, the banks have gone down from lending 75% to 50%. So there's less leverage in the markets. The buyers are saying, well, Powell is not done raising interest rates, so I can't buy it at today's valuation. I have to buy it at next year's valuation because next year it'll be worth less, right? Because if you're buying a cash flow property, you want to get it to cash flow above the interest rates that you're paying, above inflation. So you want to make money in real terms. So everything is compressed down, and there's uncertainty because maybe interest rates, are done next month, but maybe in 1 year, maybe in 2 years, there's this uncertainty about the policy. And that's what he means by pain, because this uncertainty is freezing everyone and it's creating distress. And it creates this distress for cash flow assets, for growth assets, for sure. It creates insane distress. So in other words, companies that lose money and need to, they have great businesses, but they're losing money right now. They either need to fire lots of people and get more efficient, or raise money at very high interest rates compared to the last 10 years. That's what he means by pain. And then for the households, what he means is, look, this means growth is stagnating, so your wages are going to stagnate. It means that real estate developers are not going to build as fast, so it means less available housing, rents will go up, etc. This is all of this thing is a huge reset of the valuations in this world as per higher interest rates, in order to make sure that what we have is, fairly high inflation, but not runaway, embarrassingly high inflation. If they get it to a point where they feel like inflation is stabilizing, moderating, and starting to lower, then we get to that point where they can stop, putting a lid on it and letting everything kind of flow more freely and step aside instead of trying to take such a. So what he means by pain is the reset of prices, valuations for real estate stocks and bonds, and the slower growth that happens for companies in earlier stages. And then there's a trickle effect to the rest of the economy from there. So this is a place where cash-rich people, as funny as it sounds, in a 40-year inflation high environment, the cash-rich people are those best suited to win. Why? Because yes, CPI is 8%, and let's say you use shadow stats or any of the other ones that say it's more like 13. Well, as you can see, this year the Nasdaq is down like 25 or 30% or 35%. So it doesn't matter if inflation is 10 or 12 or 13, because you have a real reset of global interest rates that's impacting everything down way more than just the arbitrage of the inflation. Mm-hmm. So that's what pain means, and some of the people will not be able to sustain the cash burn rate, and they'll have to shut down their company, lay down a bunch of employees, go and raise money at very high interest rates. This is the pain that he's talking about, and it's going to be very unpopular to bail out anyone, mm-hmm. because the popular thing to do is to stop inflation and inflict some collateral damage or pain or whatever you want to call it for the greater good of not having systematic inflation. Right. So anything accommodative like bailouts are now very unpopular, and it looks like the Fed is taking the really hawkish side, and then the government with like student loan forgiveness and the Inflation Reduction Act and all that, they're taking more of the accommodative side. Here, we're gonna do some public works, and we're gonna pump money into the economy while the Fed drains it. Right. So the roles have kind of reversed.
Wow. Okay, so that's a very detailed explanation as to the pain, and so definitely uncomfortable all around. And you factor in the energy crisis that's underway right now, especially with the whole Putin, as well as the European Union decided to have a little standoff right now because of sanctions and everything like that. So do you think this energy crisis, which will be a global event at some point, will this also be a factor in the Fed's decision making? Because that's another form of pain. That are they pricing that in with their interest rate hikes, because they're becoming more unserviceable on top of the cost of living burden in Europe and everything like that? That's a whole other ballpark, would you say?
Yeah, I would say that the energy crisis is a real fundamental 5 to 10 year crisis. It won't be in a crisis mode for the next 10 years, but we are definitely in Europe, and certainly it has a trickle effect around the globe. We are in a scenario of an energy reset for two reasons. One are the agendas of the World Economic Forum. And if you don't know like what's going on behind the scene with climate change and everything like that, then definitely check out wealthresearchgroup.com/WEF, basically World Economic Forum, WEF, to understand more of their agenda and how they're trying to maneuver this from behind the scenes. In terms of like Europe and what's going on, from the early 1960s, when Germany was East and West, in order to bring the two together, deals were made between Germany and Russia for the supply of oil and natural gas and coal. And because Russia geographically doesn't have deep sea ports that can carry it by ship to Europe, they had to build a network of pipelines. Just like railway systems, pipelines are truly permanent. You can't move them. They're not agile. It's not like, like moving furniture around the house. This is set in stone. So once the USSR broke in 1991, these pipelines were now running from Siberia and Russia all through Ukraine, a new country, a new sovereign country, or through Belarus, through Eastern Europe and into Germany and France, etc. This was a new reality for the Russian Federation or the new country of Russia, and they had to start, understanding the risks involved. Just like in in Africa, there's risks involved with the Nile River going through many countries, and each of them can put a dam, and there's water crisis there. Same thing with these pipelines. So this war is 30 years in the making, because the Ukraine and Belarus and Russia and the Caspian Sea or the Black Sea, the Caspian Sea, where there's the bed of it is filled with natural gas and oil, and it's been distributed to 4 of the smallest countries that were part of the USSR. That's all been huge conflicts. You had the Iraq War because of it. You had a lot of geopolitical tensions and problems because we're talking about billions and billions of dollars in profits. So once Ukraine discovered major new oil reserves in 2011, Putin started to invade as early as 2014 when he saw that he can't overthrow the government and put his own type of government in there. And in 2022, he really understood that if he doesn't do something quick, then his country, in terms of its oil and natural gas, will become less and less relevant. I don't know if he factored everything in, but at this point, we're going into a scenario where Europe is going to obviously not buy Russian oil and natural gas if they can help it in the future. So they are building the alternatives, and they are also moving into greener solutions like nuclear and otherwise, and solar, etc. So this is a problem because you're trying to switch 40-year-old transportation, logistics, and supplies that have been in place with new ones. It takes years to do that. And in the meantime, there will be a crisis. So I do see higher energy prices across the board. Then you need to think about all these other prime ministers that are saying to themselves, well, who am I getting my oil from? And they want to build their own oil reserves and be more independent. So you're seeing this separation into 2 blocks: the Chinese bloc with Russia and all the allies that they have, and the Western bloc. And that means that we are no longer in just a bottom line capitalism environment where I want the cheapest oil I can get. No, now there's another layer here of I need the cheapest and most reliable oil I can get, and that makes the price higher, obviously. Right. And so that's the global energy crisis that we have. And secondly, you have unrealistic green initiatives that are just, they may be of good intent, but they're just not unrealistic in the timing and everything else. Actually, ExxonMobil's previous CEO said that in the year 2050, oil consumption around the world will be equal to 2013. So just so everyone understands, the Western world is nothing compared to the rise of Asia and India and Indonesia and Nigeria and all these countries with hundreds of millions and billions of people that are going to consume oil for the rest of this century. So just it's very important to understand, because somebody doesn't do the research, thinks oil is going away or something. No, it's not. It's it's not going away at all. This transition will be, might even take a full century into going. Okay, so that's the energy crisis, and you also have with it a crisis in Taiwan that makes it even worse. And if anyone on this interview has not heard the name Malacca, he needs to understand why that could be the starting point of WWIII or any confrontation between the West and the East in China, Malacca. If you don't know what that is, go to wealthresearchgroup.com/Taiwan, because you have to realize how strategically important that little place is. Not Taiwan, but Malacca. Taiwan, everybody understands, but Malacca is not talked about, and now it's starting to. If you ask China experts, they will all point to that particular region, and you have to know about it. So definitely check out that report that focuses on it. I think between those two, those are the main problems that we have. After this reset is done, the reset will have victims. There will be some bankruptcies. There will be problems, but it's overall a good thing, right? You're resetting everything and calming down inflation. After that, there's a lot of good on the other side, like a lot of good trends that are happening around the world. But I think that the energy crisis and Taiwan are still don't have something on the horizon that's good.
Right. Now, as we draw towards the end, let's talk about some of the solutions, some of the opportunities that will come about through all of this that'll be worthwhile for people to take a look into now and possibly get involved with now, so that they'll be better off on the other side of this, or whatever that point that is. Share with us some ideas as to what you're keeping an eye on. What are some things that's worth really looking into now? Okay.
First of all, stock market. The stock market, there's no rush. If you can build a watch list of the 10, 12, 15, 20, 7, 5, whatever your investment style is, of the highest quality, best companies that you want to own, you should start simply, and at least that's what I'm doing, just buy. Not all at once, but just all the time. Buy more of them. You're in a reset environment, and in the future, these good companies, if they're really good, if they're cash flowing, they're profitable, they're a beast, they're growing, their mode is good, they're just one of the best businesses around, they will be worth way more. The markets right now are pricing in so much distress that the prices you're seeing are bargain prices. Because we're not seeing a full-on crash, you don't think that. But what we are definitely seeing is like a slow leaking of air from the bubble, and there's not much air left. But because it's so slow and incremental compared to what people think about, like in the .com or in 2008, people think that there's so much more to go. No, start to accumulate, because there's opportunities, amazing opportunities out there. And if you follow my newsletter, I talk about my top 10 companies all the time. So you can get access to those through the, just by reading the newsletter. So that's one thing with the stock market. In real estate, I think that there are good opportunities if you're an accredited investor and you have access to great deals. Okay, so if you are an accredited investor, start looking for funds that have very good reputation and good results. If you're not accredited and you still want to get into real estate, I think that what you'll see if you wait and you start building your skill set right now is, on the flip side of this, I just came back from Italy, Mike. There were so many American families that brought the entire family for a wedding, okay? Or for one of those where you light the torch and it's either pink or blue for the gender. So many millennials are either getting married or having children. Bottom line, all of these people need homes. So once we get into a comfortable place with real estate, there is 80 million millennials that are getting married and forming families that need homes. There's going to be so much growth in real estate in America in the next 10 years. If you can somehow get into that as an agent, as a developer, as an investor, as a marriage of all these, real estate could be your second career, your primary career, your side hustle. Get into real estate right now to start building your skill set, and then get ready to have a phenomenal decade ahead of you. So that's real estate. Third, debt. Fixed income is back. We were in a decade of TINA. There is no alternative to stocks. That's over, right? There are now alternatives. In fact, if you look at like regular companies that you and I know, I can give you an example from my hedge fund manager who called me and said, Lior, I can either buy stock of American Airlines, or I can lend them money at 11%. So there is now an alternative, right? In the days of 3%, you're like, okay, I should probably buy the stock. Stop roll for more than 3% growth. Now you can lend money at 11% to a company like American Airlines, and there is an alternative for you. So start looking again at debt and debt opportunities, lending in real estate, lending in the stock market, etc. It's back, not to the government for 3%, but to to companies and corporations and real estate. So that's the third thing. And fourth is if you want to wait and really wait, you should build just a massive cash position and wait until Powell starts to declare victory, until the mood changes, until you get that all clear sign. Stocks may bottom before that and start an uptrend. That should not deter you, because you just went through a generational reset. So if they bottomed at 1 and they're now at 1.5, they're going to 10. Stocks are going higher and higher and higher. We just had a major reset. So if you want to wait, no problem. Wait and then make up for lost time. Go in heavier after the trend is already there. There's obviously a lot of hedge fund managers that are working that style. But if you're a retiree and you need income, then that's something else. But if you have time, nobody's rushing you, build a massive cash position. In terms of gold and silver and what I think about them, because we haven't touched on them, maybe you were mean to ask or something.
Right.
I think silver is in a bind so long as the dollar remains like the best performing asset class in the world, and definitely the best fiat currency. And once that changes, it will be just like in the year 2000 when silver was like $3 or $4 an ounce and went to 20 or 21. Silver, once this reset is over, wherever it settles at, 13, 14, 15, it has the potential to triple and quadruple from there. This was a huge reset for silver. Gold, I think gold is mimicking 2018 behavior. So it's definitely weakening, but it has the potential, once it finds the bottom, it has the potential to go up by 50 to 60%. So if it finds the bottom around 1,500 or 1,400, it's going to over 2,000 an ounce. So both of these are in reset mode. If you don't own any, good time to start accumulating physical. If you do own, I would just hold. If your purpose is to make a lot of money in gold and silver, then I think you should wait for the trend to come back. You just don't know how long this could last. And that's, basically I went through most of my most important asset classes.
All right. Well, Lior Gantz, as always, a wealth of knowledge. I appreciate you for joining us here on RTD Interviews and definitely laying out your forecast, where we're at, where we're heading, and some opportunities that lie ahead. So once again, thank you for joining us. And of course, I'll put the link to your website down below so people can plug in as well and get a chance to get some of those reports there. But other than that, Lior, thank you again for joining us on RTD Interviews.
I appreciate it, Mike. Thank you.